Roughly 7 weeks ago, I published a research note titled, How to Play the End in the Bank Rally, which detailed why it was a good time to sell bank stocks and buy utilities as a pairs trade. Since the writing of that note, utility stocks, expressed through ETF XLU, are up 4.78%, while regional bank stocks, KRE, the recommendation, are down 1.55% for a 6.33% return on the trade in 7 short weeks. I recommended selling regional banks, but if you happen to sell big banks, XLF, the performance is even better as XLF has fallen 4.76% since the writing of the last note. PS. Total return performance, % since May 9th, source, YCharts, EPB Macro Research. Although the last article was filled with data supporting this trade idea, the comments were overwhelmingly negative, most of which can be summarized as, "You are crazy to sell bank stocks." Well, given the performance of 6.33% or 9.54% based on which bank index you sold, I think the trade idea should at the very least be given additional consideration. I fully expect more comments in that regard, but sticking to the data is what yields the performance. The original analysis called for this pairs trade, long XLU, short KRE, with a holding period of 12 to 18 months. Given the strength of the performance in just 7 weeks, taking another look at the analysis behind this trade idea makes sense. Should you hold that position if you already put it on? Is it too late to put the trade on now after such strong performance? I will run through the analysis again below, updating any data that requires revisions to see why this trade has worked and if continuing to hold the position as original stated remains the best approach. It is perfectly fine to change your position as the data changes, so let's take a look at what has unfolded over the last 7 weeks. One final point. This is not an naked short banks call. This is a pairs trade. You can short banks and buy utilities or buy some other long index such as SPY or the Russell 2000, IWM. The idea is a relative value trade, not a blanket short banks call. Conditions becoming less favorable for bank stocks, Part 2. Before moving on to the analysis that supports the short bank thesis, I want to repost some common misconceptions about the long leg of this trade. In Part 1, I tackled the idea that utility stocks don't perform well in a rising rate environment. Most analysts and pundits wanted to stay far away from XLU several weeks ago due to fear of rising rates. That fear has cost over 5% so far and is based on misinformation. First, it is important to distinguish rising short-term rates from rising long-term rates, as the two do not always move in tandem, hence the flattening yield curve. In 2006, the federal funds rate rose 100 basis points from 4.2% to 5.2% and utility stocks gained 21% on the year. In 2007, XLU rose 18% compared to a decline for KRE of 22%. Utility stocks outperform financial stocks late in the economic cycle and underperform when growth is robust. Below, I will make the case that the rally in financial stocks has run its course and it is time to shift out of banks and into defensive sectors, such as utilities, to prepare for the end of the business cycle, despite the rising short-term rates, as we have proven that rates can rise 100 basis points on the short end without impacting the performance of utility stocks. The analysis for shorting bank stocks relative to a more defensive long exposure was initiated on the basis of a slowdown in consumer credit growth, rising interest payments for debt-burdened consumers, a flattening yield curve and contagion in the banking sector as a whole from emerging markets. A brief recap of those data points argues that the thesis for this trade has not changed. The growth in credit card debt continues to stagnate, which could be a negative influence on bank earnings. Not only is this trend less profitable for banks, whose share prices have gotten very overextended, it also has been a historically bad indicator of consumer health. Credit card debt. Source: Federal Reserve, EPB macro research. When credit card debt slows, history suggests that there is something wrong with the consumer, or more specifically, the consumer is getting maxed out. Year-over-year growth rate in credit card debt has dropped from 7% to 5% in the past year, while the change over the past quarter is nearly exactly flat, indicating the slowdown in debt is accelerating to the downside. Credit card debt year-over-year. Source: Federal Reserve, EPB macro research. Interest rates have gone up recently, which is adding to the burden of the consumer. Personal interest payments have reached a new high, moving above the last peak in 2007. What is more important than the nominal level of personal interest payments is the rate of change in those payments. Highlighted in the red circle is the last year or so, in which you can see a rapid acceleration in personal interest payments. A sharp rise in personal interest payments is more likely to have a sharp countermove in terms of a reduction in consumption. Personal interest payments hit new high. Source: Federal Reserve, EPB macro research. Consumers are clearly feeling the pain of high debt with rising interest rates as delinquency rates at small banks continues to rise. Increased delinquencies and a reduction in new credit card debt can serve as downward pressure on banks, specifically smaller banks with fewer businesses, to offset the consumer slowdown. Credit card delinquencies, small banks versus large banks. Source: Federal Reserve, EPB macro research. The yield curve continues to flatten rather dramatically. The spread between the 30-year Treasury and the 2-year Treasury yield has fallen from roughly 60 basis points to 49 basis points over the past 7 weeks. The flattening of the yield curve is very important for banks as it pertains to the profitability of lending and other financing activities. Rising short-term rates are good for banks, but lower long-term rates are not. 30-2 spread. Source: YCharts, EPB macro research. Sim made the argument in my last article that the 30-year yield was not a good measure and that the 10-year yield is more appropriate. The 10-2 spread has flattened even more substantially in recent weeks, down to 35 basis points. Bank profitability is likely to come down in key divisions due to the flattening of the yield curve. 10-2 spread. Source: YCharts, EPB macro research. As the Federal Reserve continues to reduce liquidity, bank credit, which is made up of bank loans and bank securities, continues to contract. Bank credit is contracting due to very aggressive tightening efforts by the Federal Reserve, most specifically, the unwind of the balance sheet. Click here for more on that. The year-over-year growth in bank credit is near the lowest level in the past several decades, outside of the Great Recession. Bank credit also has historically contracted into each economic slowdown, which makes the sharp declines seen today a cause for concern. Bank credit growth. Securities loan book. Source: Federal Reserve, EPB macro research. The contraction in bank credit that started at the end of 2017 is due to an aggressive monetary policy which has dramatically reduced excess reserves. Many will claim that reserves are still plentiful, which they are, but it is the rate of change that matters. Bank reserves are contracting, and fairly rapidly at that. Lastly, the rise in the US dollar, which has also been caused by a contraction in liquidity from the Fed, as well as a divergence in global interest rates, is severely impacting the emerging markets. Collapsing currencies can be seen around the world, which has impacted equity markets and bonds as well. Emerging market spot returns year-to-date. Source: Bloomberg. Falling emerging market currencies and emerging market debt will serve to put a bid under the US dollar and long-term interest rates. Many market participants hedge bond exposure with treasuries, and further declines will likely put additional downward pressure on long-term yields. Long-term yields are holding steady and likely to fall soon in my opinion, due to a variety of factors, but significant contractions in the emerging markets will also be a driver of potentially lower yields. Lower yields will cause the yield curve to flatten even further and likely invert if the Federal Reserve commits a policy mistake and raises rates again. Trending in the direction of an inverted yield curve is a bad position for banks. Summary: all of the trends that were used in Part 1 as a reason for going long XLU and selling KRE are still intact and in most cases, worse. Consumer credit is slowing, the yield curve has compressed further, bank credit is near the cycle lows, and a rising dollar is causing massive emerging market pain. The time frame for this trade is 12 to 18 months, which will prove to be enough time for both the effects the consumer slowdown to impact bank profitability as well as the negative impacts from Federal Reserve tightening and yield curve compression to appear. Should this analysis prove accurate, XLU may have a negative total return, but there is likely to be an outperformance over KRE, which is why the actionable idea comes as a spread trade. Note from the author: scroll to the top of the page and click the orange "Follow" button to make sure the next article one right goes straight to your inbox. Make sure you check the Get Email Alerts box. Looking forward to hearing from you. Disclosure: we are long XLU, SPY. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from Seeking Alpha. I have no business relationship with any company whose stock is mentioned in this article. Additional disclosure: short KRE.